Everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Beau Woodward, who is a partner at Woodward Diversified Capital. Beau, how you doing?
I'm good, Tim. How are you?
I am doing fantastic, and we like to jump right in, getting to know you. Why don't you start with telling us a little bit more about your firm, about who you are, and your kind of journey into the financial space?
All right. Well, first, thank you very much for having me on your show. Appreciate it very much. It's nice to get to meet you guys and learn more about Stallion Capital. Woodward Diversified was started by me, my brother Gabe, and my dad Tom in March of 2020, literally right at the depths of the COVID crash, March 20th, if I remember correctly, the exact date. We formed an independent RIA that we structured to really give us the flexibility to do whatever we wanted depending on where we saw opportunity. And that, has kind of morphed into a multifamily office now. And we both source projects and, invest in a multitude of funds around the world really at this point. So it's been kind of a wild ride, and it's been a lot of fun.
So before that, what was the impetus for you guys gathering to start this firm to kind of go wherever you want? Did you see a lot of opportunity on the horizon? Were you guys tired of being in your separate spots split? Talk to me a bit about that.
Great question. So we had a pretty high net worth, ultra high net worth family office size group of clientele. Working as brokers at Wells Fargo, just regular old stockbrokers for a number of decades, really. And there was a few times where one of our clients who had a particular area of expertise started a new company, and we invested on the private side personally with him. We had other clients who knew him and wanted to invest alongside of us. And when we talked to our brokerage firm, at the time Wells Fargo in this case, they said they couldn't facilitate that and we couldn't do it. And so the second or third time that happened, I can't remember which one, it might have been the third time, in the kind of ninth hour, Wells Fargo came in, a separate division of Wells Fargo, and ended up investing in his company, different guy actually in this case, his company. And we were kind of burned by that, you're going to exclude us and our clients who know this guy and want to participate, but then you're going to come in after the fact and do it, and we, had gone through all the proper channels to try to get approval for that. And it just didn't work out. So, once that happened, we kind of made the decision we need to form our own separate firm where we have the flexibility to kind of go anywhere and do anything that makes sense. So strong motivation.
And I bet your clients were happy to come with you after that too. Huh?
They were. We had, over 90% of our clients come with us, which was great. And our business has grown very nicely each year since we launched. And, it's been a lot of fun, frankly,
Absolutely. I love it. And so is it just you, your brother, and your dad, or are you guys starting to onboard other advisors as well?
We have not. We've looked at that a few times. We've had a few teams reach out to us from really all over California, mostly SoCal, and it hasn't worked out yet. But it is something that we're definitely open to and hope materializes over the coming years. We have a few key support staff here that work with us and help facilitate a lot of what we do. So it's kind of a slowly growing team. We brought in a few general partners that were kind of managing their own family offices and were particularly astute and had certain areas of domain expertise that we felt were very compelling. And so we brought them in as well. So it's kind of slowly growing organically, which in my opinion is the best way to grow. So.
And do you guys each have your own specific expertise, or are some of you kind of general and then you have a few experts that you go to when the situation arises?
Yeah, we have specific areas of focus. One of the general partners is a medical doctor who's 45 years old and really semi-retired and runs his own family office now. And so we each have our different areas of expertise. I could kind of go on and on about different areas of expertise for different partners, but
Yeah, no
I'll
need,
leave
no
it at
need.
that. Yeah.
For sure. Well, talk to me a little bit about where you guys go to stay up to date with the latest market trends, financial strategies. Like you're sourcing all these opportunities because you're off on your own now. Talk to me about how that works.
So it's really it's a big question, to be honest with you. There's several different kind of pools of either capital or ideas that we are involved in at this point. So there's some multi-family office conferences, that you can go to. I'm sure Stallion Capital goes to a lot of those. Those tend to be good places to find investment ideas and meet potential investment partners on things. And so that's a really good resource. As far as like capital market research, we're looking at kind of all the normal, pardon me, all the normal groups. Goldman Sachs, JP Morgan. We like First Trust quite a bit. They have a lot of good, interesting ideas, we think. We deal with several fairly well-known hedge fund groups. I don't know if you've heard of Alpion Capital on the tech side or Third Point. They tend to be good resources as well. So yeah, we kind of hit all that stuff, read the normal Barron's and things like that, love that stuff too. So
Okay, so you got some conferences, you got the normal resources, and then working with some particular groups that well known in their sphere, so they have a kind of pulse on the market, if you will. I want to jump to the current market. What are the kind of factors that you think are most important to pay attention to in today's market, and what's your high-level strategy to address them?
I think the most important factors are really the basics: inflation, interest rates, what the Fed's going to be doing or has recently done, in this case, how the economy seems to be holding up, and on that front, just for what it's worth, like our sense is that, we're coming to the end of the high risk period for the economy to kind of fall off a cliff, and it hasn't yet. In fact, the economic data, for whatever reason, some people on our team ascribe it to the efficacy of the tax cuts back in 2021 that helped a lot to rebuild consumer balance sheets and corporate balance sheets. It's kind of a unique benefit there to those tax cuts that seems to have resulted in more resilience over the last 6 months. The Fed had the most aggressive tightening, I think, on record at 75 basis points a clip per meeting for 9 months in a row, I want to say, something like that. And we really expected a recession sometime between Q2 of last year and Q2 of this year. And here we are in February of 2024, and all of our modeling is saying that GDP growth is going to be positive this quarter and probably positive next quarter as well. Given that the Fed stopped hiking interest rates about 6 months ago now, that tends to be the end of the period where you're most at risk to start to drift into recession. And so we think the rate of change will start to materially improve at some point during the second quarter, at the latest during the third quarter. And so if you need 2 quarters of negative GDP growth in order to have recession, it doesn't look like we're going to get it, which isn't too surprising given that we're in a presidential election year. Of course, the politicians are going to spend just a little bit more on a regular basis to help pad the numbers and make sure when they're going into the elections, they look like they did a decent job, or at least can say, hey, we never had a recession ever since COVID, and things have been pretty, we got inflation under control and we didn't have a recession. Look how good of a job we did. I will throw in there one more little interesting tidbit. Valuations in public markets aren't particularly compelling. So we've been finding the private investment kind of category, private equity, venture capital, private real estate debt, like you guys do, to be a lot more interesting. As a result of interest rates being hiked so aggressively this last cycle, you saw the NASDAQ down 32%, I think it was, in 2022. The S&P was down 19% in 2022. And so what happened was there was a commensurate drawdown in private equity valuations, and at the same time, a dry up in capital availability to those private companies. They kind of went hand in hand. As capital dried up, valuations had to fall in order to attract any capital at all. And when, people can get 5.5% in the money market fund, they're a little more hesitant and a little more picky with where they deploy their capital, And so we just see a lot of opportunity there. There's a lot of high quality private companies that are looking for capital. And so that actually has caused us to launch a new fund here in the last month, just in the last month. So
yeah, absolutely. And we were talking a bit before the show, and you were saying that fund was primarily to take advantage of opportunity. So I would love to jump into that. Tell us a bit about the fund, kind of what you guys are doing, the opportunity you're seeing, a bit more in depth.
So as a kind of family office, multifamily office RIA, we have predominantly done very targeted deals. So just a few brief highlights of that, this just to give you context for why we ended up structuring our fund the way we do. We bought a 65,000 net acre oil and gas property from Whiting Petroleum when they were emerging from bankruptcy in 2021 for about 2.5 times EBITDA. And, that's coming off of a previous 12-month period where oil prices went negative. And so they had spent about $2 billion on the property, and we bought it for $187 million.
Oh, wow.
90% off, basically.
Yeah.
It had existing production and cash flow, and honestly, it's been a phenomenal buy. We projected like a 10% dividend in year one and ended up kicking out just over 30% in year one, just over 35% in year two. It's been a great buy. And we've done we do oil and gas. So we also like to do things that are kind of more environmentally friendly. We invested in a alternative energy company. It was a startup called Rondo Energy that has pretty much the coolest industrial battery I've ever seen. It biodegrades back into Earth. You can literally turn it back into Earth like in a day if you want to. But if you just throw it out on the ground, it'll biodegrade back into Earth within like 20 years tops. It stores and transfers energy at 98% efficiency. We love that company. Breakthrough Energy Ventures and Energy Impact Partners kind of came in right around the same time we did and invested, and the CEO does a great job and has been killing it the last couple of years as that thing has grown. So we've traditionally done these kind of one-offs, as I think most family offices end up doing a lot of the time. You kind of put some money with funds, and then you do some one-off investments. In the course of kind of growing our group that we're doing business with, we kept running into these opportunities in private companies where that it was an idea that we didn't want to put like 20 or 30 or $40 million into, but we really liked it. In order to do a one-off and pay for the audits and the K1s and all of the associated expenses with it, we feel like we need to be putting at least $4 million into anything. And we kept running into things that were in that kind of $1 to $5 million area where that would be our comfort level for it, but there wasn't a lot of motivation to go ahead and do a one-off for that kind of smaller amount of capital. And so given the environment over the last 9 months with valuations coming down and getting better looks at higher quality companies as a result of the environment, we ran across so many really compelling ideas in that kind of $1 to $5 million space that we thought, let's launch a whole fund where we can maybe pool together 12 to 24 of these private company investments that are in that kind of $1 to $5 million space. So if you're down for it, Tim, I'd love to tell you about one or two of those just to give some color and context to what I'm getting at with that.
I'm super excited to hear about them.
Okay, cool. So, one of the ones that exemplifies this the most is a company called Caban, Caban. And Caban actually won Bloomberg's Startup of the Year competition a few years ago. They are decarbonizing the telecom industry. And I don't know if you remember, but over the last like 20 years, one of the companies that was just perennially in every large cap growth fund's top 10 holdings, and even before that, small cap growth fund's top 10 holdings, was a company called American Tower. AMT was the symbol. That thing's chart over a 15 to 20-year period was literally pretty much straight up and to the right with an occasional hiccup, like in '08 when the market crashed or whatever. And Caban has a very similar model. They basically go into all these different cell towers and they take them off the diesel engine that they've traditionally been powered on, and they convert them to solar. In doing so, they dramatically reduce, and I mean by like more than 50% per year, reduce the maintenance costs associated with those cell towers. So just at face value, not even counting the fact that they are decarbonizing the facility, they're actually improving the bottom line for all these different cell phone carriers, okay, telecom companies. And Caban has patented a few key pieces of what they do that gives them an advantage over the competition. In fact, through those patents, they're able to facilitate 3 different items, and I won't get into detail on what those 3 different items are, but their closest competitor can only do 2 of those 3 because they don't hold these patents. Okay.
Yep.
Yeah, and so that closest competitor, this is kind of interesting. So Caban's already in with 14 different major carriers, telecom carriers, and already has decarbonized more than 700 locations. It's scaling out to 4,000 locations this year. Deutsche Telekom, T-Mobile, Millicom, like there's several others that they're doing business with already. So existing revenues of about 15 to 20 million. I can't remember the exact number off the top of my head, to be honest, but it's right in that range. And they're projected to do probably 100 million in revenue this year. So what's interesting about that 100 million is they have $90 million of it already in signed backlog, like signed contracts ready to go.
Yeah.
Okay.
So I was about to say that's a hefty projection to not have
but
the signed contracts.
90 of it already locked down. Yeah, exactly. Right. And so their nearest competitor just this last year that can only do 2 of the 3 components, right, that Caban can do, they just recapped on $100 million of revenue at a $1.6 billion valuation. And the entry valuation for Caban on this last round that's closing up like right now pretty much is about 200 million. So a massive difference between the two, arbitrage between the two. And we think within 24 months, it's not hard to see Caban worth more than $1 billion. That's a very high quality company that should be recapitalizing higher, but the nature of kind of where they are and all of this order backlog coming in over the last 3 or 4 months while they're doing this capital raise has, left potential investors with a very attractive risk to reward profile in the company. Yeah. So that's a good example of one. I'll tell you about another one that's a cybersecurity kind of next generation cybersecurity company. So we 2 friends of ours are like legitimate cybersecurity experts who have worked for the government in various shapes and forms, and we had them vet 2 different cybersecurity companies that we're including in here. AI is going to dramatically change cybersecurity. The ability of the AI to deep fake just about anything or anyone is unparalleled with anything that we even have perspective for. And so this one particular company, Atom Networks, which has now been repped a few times, I believe, on one of the main cybersecurity podcasts, an approach that's called a zero trust approach. The U.S. government just mandated recently for all critical infrastructure to be protected by a zero trust cybersecurity approach. And this company, Atom Networks, appears to be from independent experts who don't know each other at all. They're both telling me this is the best cybersecurity approach they've seen for a new world driven by AI threats and cybersecurity. And essentially, traditional cybersecurity will let the thieves into your house, so to speak, your proverbial house, and they'll start stealing stuff and breaking stuff, and you'll realize that they're in there, and the police will show up and kick them out and try to board up the windows and doors a little bit better, so it's harder for them to get in next time. Adam Networks has a unique approach that basically never lets them onto the property. I could go into great depth as to how that works, but the analogy is much easier to understand than a lot of the technicals. And so what we like about Adam Networks is obviously we're getting in at a $36 million valuation, and they did about $1.5 million in revenue last year. That revenue comes from a few different key customers, one of which gives us great comfort that we're investing at a level to where within 18 to 24 months, the company is going to be worth a lot more than what we're investing at. I've said that a couple of times now, so I just want to give some color around that. I look at decks all the time. I'm sure you guys do too. You project out to 2028, 2029, and that all the numbers always look really good in the projections, and I like to tell people, I don't even know what my company is going to make in 2028. If you're asking me within $100,000 or within $1 million, it might be easier within $1 million than within $100,000, but it's just, you're looking out that far and there's a lot of different variables, and, I'd like to think that it'd be way better than my projection, but who knows? So what I like to look at and what we try to implement within anything that we're doing is we want to see, is the valuation that we're getting in at right now based off of last year's revenue attractive? You can forecast in this year's as well, and that's very reasonable, and we definitely take that into consideration. But the key variables for the growth profile are really, do they have the existing relationships and contracts that are going to give us a high degree of confidence that they can meet just their next 2 years worth of revenue growth? Because if they already have those relationships and we can see that those have been growing and that the technology or, value-oriented business that they're providing to their relationships has more scale and scope to filter through those companies, then we feel great about those revenues growing over the near term. And we have a high degree of confidence that at the very least, we're probably not going to lose money on this. It's probably going to be worth, maybe 2 to 3x more than what we're investing at over the next couple of years. And, Adam Networks is a great example of that. So they have a relationship with Canadian Tire, which is kind of like the Walmart of Canada. If you're from Canada, you know that. If you're from California, you might not know that. But it's the same sort of, family-owned, big box warehouse kind of retail chain. And for the last 2 years, Adam Networks has been providing cybersecurity to Canadian Tire, to 100 locations for Canadian Tire on a break-even basis. And just in the back half of 2023, Canadian Tire asked them to roll out to all roughly 1,700 locations for Canadian Tire. And Adam Networks was like, we will gladly do that, but we can't do it on a break-even basis. So it looks like to us that they've priced themselves about 10% under Palo Alto Networks, which is smart. And we can have visibility that $1.5 million of revenue last year is probably going to translate to, and this won't be strictly from Canadian Tire, right? But to dramatically higher revenue, probably even between their different customers and everything. They have 7 schools in the UK, and they have a few other customers as well. And actually, because they got ripped on this podcast, their phone's kind of ringing off the hook over the last month or so since that happened. But to at least $10 million in revenue by 2025, probably even by the end of 2024, $10 million plus run rate. If you factor in kind of even these more trough multiples that we're getting right now in private markets, it's easy to see that company worth $100 million or more, maybe as much as $200 million because of their growth profile. So from a $36 million cost basis to $100 million is 3 times our money, round numbers, ish.
Yep.
Over a 18 to 24 month period. And then obviously a technology like that has the potential to be worth $3.5 billion, which would be 100x on your money. So who knows if how far and how high it can go, but we know there's a market for it. And we know that just the near-term visibility gives us great comfort in it being worth more than what we're investing in. So that was a lot.
So when you're looking at potential investments for this fund, you're primarily ensuring that the companies you're investing in, and when you're doing the projections for the companies that you're investing in, you're ensuring that they either have the relationships and they've been growing and there's reason to believe it will continue to grow, or like literally the contract's already signed and basically they have receivables ready to collect as long as it's fulfilled.
In the overwhelming majority of the cases of our target investments, just for this initial round, which hopefully will be most of what we end up investing in, they have those existing contracts, the relationships, the contracts, and all they have to do is grow into those relationships through those companies by, applying whatever they do throughout the company. And so that gives us great visibility.
Absolutely. And are you guys working with a few key families to operate and raise for this fund? Is anybody able to come into this? Like, talk a little bit to that.
Anybody can come into it for sure. And yes, there are a few key families that have seeded initial capital. We've already placed about $5 million in a couple of different companies. A few of them, one of them we funded we did $1.5 million into, and the two others that we've already funded, we are funding kind of over a few month period based upon cash flows around here for everybody's businesses that are kind of coming in. And then, but it's open to anyone. And we do have kind of outside interest that's just kind of materialized out of word of mouth, to be honest with you. And, frankly, it was very fortuitous for you to reach out to me at this time. I'm like, oh, that's perfect. I'd love to, get to know more about Stallion Capital and talk to Tim about what we're doing on a podcast. That'd be great.
Yeah. Yeah, absolutely. Well, tell me a little bit about risk in the portfolio that you're looking to build when it comes to multiples. Like, is there any chance that the multiple profile changes significantly and then
Love that question. We're actually working with a large family office out of Texas. We are buying into a business that they own and have grown. And essentially what they're doing is it's called Frontline, actually. And Frontline is in the kind of dental and orthodontic space. They have a surgical expertise. They have partnered with some of the top doctors in the country that are in their group. And they basically, you look at these practices around the country, we call them DSOs. So these regional dental groups, and they tend to not be growing really quickly because, like 60 to 80% of the population can't afford $5,000 to $7,000 for braces or whatever. Frontline actually does more surgeries, which are even more expensive. And so they don't tend to grow really quickly, though. And so they trade at a multiple that's like, 8 times EBITDA, or they sell at about that. So we come in, Frontline comes in, and they buy them at about 8 times EBITDA. And then they help them digitize what they're doing, which gives them some additional profit margin, say mid-single digit improvement to profit margin. They put them in their group with the marketing that they do for the group. That tends to accelerate growth a little bit. By being in the group, they get an economy of scale, so their cost of goods fall as well. So that bottom line starts to improve fairly dramatically at the same time that the marketing helps accelerate the growth a little bit. Okay. And then on top of that, they bring in another company that's one of our portfolio companies called HFD, Healthcare Finance Direct. And Healthcare Finance Direct helps finance procedures. So instead of being able to capture just 20 to 40% of the market, all of a sudden you're able to capture at least double that. Okay, oftentimes even more than double that because there's a financing option. And so once you apply that, the growth profile starts to accelerate further. Then on top of that, you add that they're bringing in practices on a somewhat regular basis. So the growth profile as Frontline as a whole starts to grow. And so when you put all that together, you're buying these practices at about 8 times EBITDA. We should be able to sell Frontline, for mid-teen multiples, maybe 14, 15, 16 times EBITDA. maybe a little bit better than that. So you capture growth for a year or two, and you capture the spread of improvement on the multiple.
Really, when you're looking at these to hedge that kind of risk of multiples being off, it's really, I'm adding so much value, and we're making this such a system where we're ensuring through our value add that multiple is where we want it to be.
We view it as a very low risk. Just because there's a lot of ways to win, it already has good momentum. Leon Healthcare Partners, who owns Frontline, has been gracious enough to let us come in and invest alongside them in their growing business. So it's been cool.
Yeah, I gotcha. That's awesome. So are there any industries, I know you said you're looking to pick up about 12 to 24 companies in this fund. Is that right?
Correct.
Do you already have the 24 deals in the pipeline, or are there any industries that you want to really learn more about and find an ideal purchase for?
Great question. I'm not sure I have a straight answer for that, to be honest with you. We only have 9 companies targeted so far. We've looked at, at least quadruple that, but 9 that have kind of made our cut so far that we are very interested in participating in and in negotiations with the CEO and the management teams there. So we will be looking to add to that group for sure. We have a second list of another 5 companies that are in the strong possibility camp. And we will definitely be looking to grow that list as well. We would like to be placing at least most of our capital before the end of the year. Private equity vintages tend to perform best when you're investing while the economy isn't kind of troughing. Usually in recession. In this case, we've had kind of a mid-cycle slowdown is what it's looking like more and more. So we want to put that capital to work while the economy is a little bit weak and valuations are a little bit low, and not so much when we're full tilt in the recovery and valuations are higher and we've already missed a year of growth or two, So we're hoping that we can identify 6 to 10 more. That being said, this group is so strong, we're definitely going to be increasingly picky and prudent in where we choose to invest the remaining capital that we raise throughout this process.
Yeah. And so do you guys have so it's 12 to 24 companies at about 1 to 5 million investment per company?
Correct.
And so are you guys, is the target raised right around 100 million? Is it a little bit less than that, a little bit more than that?
Actually less. It's more like 50. Yeah. We have a soft goal of a kind of at least 30, and we want to be content to not spoil the returns by just adding capital and or placing capital just because we have access to it. So we're going to be pretty disciplined on that. Part of the advantage, you might say, or like a silver lining is probably a better way to describe it. The silver lining of having a small team is you don't feel like you have to have a huge fund. So if you have good ideas and you have placed, a healthy amount of capital, in a lot of the cases we own 10 to 20% of the companies. Not true with Frontline at all, but with a few of the others that we're participating in. We feel like that's a healthy amount of the company to own. We don't want to own 50% of a company, really. Partially because we are a small team and we don't have the time to go make sure we're managing that really closely. We have other ventures where we own 85% of them, like those oil and gas stuff that require a lot of time and energy and effort, or have in the initial setup of them. Now they're a little bit more on autopilot's not the right word, but it's kind of like second nature running them. We have a very strong grasp of those, so they don't require as much attention and intellectual horsepower to make sure that we're thinking through all the issues thoroughly. So, we're not looking to have tons of companies or tons of capital. We're looking to be very targeted and really like and have a high degree of comfortability with what we own.
Yeah.
And whatever that amount ends up to be, if it's 30 million, if we were to get to 70 million, I would probably just hard cap, like no more capital. And hopefully some of these companies would allow us to kind of double down on some of our investments, just because we have a really nice quality group that we can go on and on about. So
if you 3 to 5x 30, 50, 70 million, you're not doing too bad.
Right. and everybody's happy and everybody likes it. And if we ever do it again, everybody's like, "Oh, I'll do that again. That was nice. That worked. That worked."
Yeah.
You know. We also, I'll say one last thing about it. We actually structured it in kind of a unique way that I feel is particularly compelling. We have three different investments, one of which is Frontline, that we expect to get exits from within 2 years for about 3x on each investment. And if all three of those, we view those as low risk, high probability outcomes. We're not trying to get 5 or 10 times our money. It's just, we can get in because valuations are low and businesses that are growing at a nice clip where everything about the business says the management is going to want to exit within about a 2-year time period. And so very high probability, we have roughly 100% of everyone's money back to them within the first 2.5 years, which is kind of unique in a private equity fund where they usually lock it up for 5 to 7.
Well, awesome. So we talked a little bit about the current market. We dove into the fund a lot and how that is an alternative for how people should allocate their portfolios. But the average person listening to this might have 1 to 3 million in net worth. Maybe they're an entrepreneur with a bit of liquidity. If they wanted to come into this fund, how much are you like? Is it 100,000 minimum? Is it $1 million minimum?
Good question. Yeah, it's a $250,000 minimum for the fund.
Gotcha.
Yep, for new relationships, to be specific. Like when we have, for all of our legacy investors, family offices and different entities and whatever, like that invest with us, endowments and stuff, if you're already participating in one of our funds, then we kind of give you like freedom to invest whatever your comfort level is. So most of them still come in with $1 million-ish, but we made $250,000 minimum for this fund for a new relationship. The way the legal structure works, you're only allowed to have 100 investors. So if 100 investors do the minimum, we got a $25 million fund.
Cool. Well, do you feel like we have missed anything, or do you feel like we've covered it all?
I don't. I appreciate you being willing to listen and kind of share the story with your group. And, I'm very thankful. So appreciate it, Tim.
Yeah, I appreciate you, Beau. The show is all about bringing innovative investment ideas to the people listening so that they can make their portfolios do what they want it to do. And this sounds like a great opportunity for everybody. High growth here, and then you can come over to Stallion and get your steady, consistent 7-8% ticket on some of your capital as well.
Which has got to be great right now, I'm sure.
Yes, for sure. Well, cool, Beau. If people want to know more about you, if they want to know more about the fund, where should they go to contact you?
Our firm is called Woodward Diversified Capital, just like it sounds. Woodward is spelled just like the skate parks for anybody that ever sees those skate parks, WOOD, WARD. And our website is woodwarddivcap.com. My email is Beau, BEAU, @woodwarddivcap.com.
Yeah, for sure. Will do. And guys, all that information will be down in the show notes. Beau, thanks for coming on the show. Guys, thank you for listening, and we'll see everybody on the next one.